Hey there, we're live. It's 4:30. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. It's my post market live stream about personal finance, investing, and all the things that I think you really need to know, or at least know better, in order to make the best possible financial decisions for yourself and for your family. That's what this show's all about. We've got a lot to talk about. Yesterday, I started the stream by saying, holy SH, you know what? Continuing to today, because yesterday was such a big game changer. We've had, low rates and easy monetary policy for so long that with yesterday's dovish Fed Governor Lael Brainard going all out hardcore hawk, it's just like, wow, the stock market is in for a rude awakening. Investors, home buyers, it changes everything. Everything is tied to interest rates. I'm sorry about the blinking on the screen. I just don't know what the hell that's from, and it happens a lot. And I've tried everything electronically with my equipment, and it still happens. Whatever. Maybe I just need new cameras. Maybe I'll get new cameras. I was thinking of, I haven't bought new stuff for a while. Maybe I need one new camera just to check this out. Anyway, here's the deal. The Fed has given up on achieving a soft landing. This is mission critical. So now you have to ask yourself, am I comfortable investing right now, knowing with almost complete certainty that the stock market is heading lower now? That's what you have to understand. So if your whole basis on investing is making money in the market, are you making money in the market in terms of 10 years, 15 years, 5 years? Were you thinking, well, I expect to make money in a couple of months and then I'll take the money out and buy something? What is your time horizon? Because right now, it's time to make sure you have a long-term time horizon and extend that time horizon, because we are getting into some serious stuff. A soft landing means the Fed raises rates to slow down the economy enough to tamp down inflation without sending the economy into a recession, which would then hurt employment, corporate earnings, and so many other things. But the Fed looks like it's given up on the soft landing. So let's roll the intro. We're going to talk about all of this stuff. And I've got a couple comments out there. We're going to get to that momentarily. So here is the intro. All right, I'm hoping that we have a little less blinky on camera 2. So it's still happening, but I'm on camera 2 now, so I'll just stay with camera 2. All right, just a couple comments out here. First, Mark is out there. Hey, buddy, nice to see you, and I hope your ankle is all better. I'd love to see you at the gym very soon. I know I've been back there, and I've been working hard at home and working hard at the in the gym. All right, making sure I take care of myself and get my fitness going. Shane Dooley, thank you very much. On my LinkedIn timeline, because I see you coming in from LinkedIn, just scroll down my LinkedIn timeline, go right to my post, not activity, because you'll see a lot more activity than posts, and you'll see all of my live streams and video snippets, the highlights of the live streams. You'll see them all there, and you can always catch me on YouTube or Facebook or Twitter and what have you. So I'm all around, man. Wherever you need to, wherever you are, I want to be. Okay. So thank you very much, Shane. I really appreciate you joining me. So this is significant. Interest rates on Monday went out on the day at 2.4%, which seemed to be the high end of a intermediate term range of interest rates. Yesterday, they broke into the 2.6s. It's a big jump, 2.4% to 2.63% on the 10-year treasury. That's a really big jump. Really, really big. I just want to emphasize it's really big. And that affects everything. You see mortgage rates go above 5%. Everything is tied to interest rates from your auto loan, your credit card debt. I don't know. You name it, it's tied to interest rates. So my desk is a little messy over here. And we're back to camera one. So this changes everything. It makes the cost of debt more expensive. So if you're spending more on debt, as a business, a major corporation, small business, or a consumer, it means you're spending less money on other stuff. And with inflation, you're really spending less money on other stuff because now you really have to figure out, well, my necessities cost so much more money, like oil and gas, heating oil or natural gas, uh, gasoline, your food. Okay. And your interest rate, if you have debt, if you have any adjustable rate products like credit cards or an adjustable rate mortgage, that's going to go up also. So you have to think about, do I just want to spend more money, or maybe you don't have more money to spend and you just have to make do with what you have, which means you have to cut on discretionary items. So maybe you buy less consumer discretionary products. Maybe you buy less Nike clothing, or you go to Starbucks less. Something's got to give, right? These are the choices that consumers and businesses make when there's inflation. On top of that, there's higher interest rates. On top of that, we have the Fed, which is hawkish, the Federal Reserve raising rates. It's a challenging time, and with you add in the Ukraine war, okay, uh, you know, Russia's illegal act in Ukraine, and then you add possibly a resurgent uh, variant of COVID, in England, and that's actually in the United States. It's actually a lot in the United States. This is one of those times where it just seems everything is haywire, and it feels like to me that I have never seen so many negative signs for the economy and the stock market. Liquidity, the Fed has pumped in liquidity by printing money. They pumped in liquidity into the stock market, into the economy. Now the Fed's withdrawing liquidity. So if you were a believer in the stock market, for example, because of the liquidity and the Fed's easy money policies, conversely, you have to be worried about the stock market, right? Now, I want to be clear here. The stock market looks, to me, this is just my opinion, it looks very, very shaky. I personally, I'm just giving you my own personal view. I'm not making much in terms of changes to my own personal investments because, I still consider myself young. I know what you're thinking out there. Oh, you like over 50? Hey, buddy, I still consider myself young. Okay. I've got a long way to go still. So I'm not going anywhere. What I have is long term. I'll keep reinvesting. I'll add more money into the market as the market goes down, whatever. This doesn't really scare me. So we could talk about how bad things are, but I think if you're younger or anyone with a time horizon of greater than 10 years, this is not going to be the biggest deal in the world. It's going to be ugly and scary while you go through it. Some of you, like me, might think it's what's going on in the market is extraordinarily interesting. I am a news junkie, and I find all of this. I find it all interesting. It's some of it is, yeah. We could get into what's interesting and what's not. Okay, Sally is out there. Why wouldn't the Fed try to stop a recession? Okay, I am so glad you asked that, Sally Simon. Thank you very much for tuning in. Best question like ever. Okay, why would the Fed try to stop it? The Fed tried to help us through the economy when the pandemic struck and we had the shutdowns, and the Fed lowered interest rates to zero, bought bonds, printed money, and Congress did sent out all kinds of fiscal stimulus, PPP, checks, child tax credits, etc. So they've created a monster in a way, in terms of an economy with high inflation. Now, too much inflation does wreck economies because I understand what you're thinking. Well, why is the Fed raising rates if they're going to hurt the economy? it's such a catch 22, and ultimately you have to decide what's more important if you're the Fed: hurting the economy to tamp down inflation, or letting inflation run rampant and trying to keep us out of a recession. Ultimately, inflation running rampant for too long, which then creeps into the psyche of consumers and businesses that we are in a perpetual state of high inflation. That long term is going to be much worse for the economy than a mild recession, even a deep recession. So the Fed has basically said, look, when when the Fed tightens monetary policy, typically by raising rates, by raising the cost of borrowing, and in this case now also by quantitative tightening. So quantitative easing was when the Federal Reserve printed money and bought bonds, and that money went into the economy. So the opposite of quantitative easing is quantitative tightening, where the Fed not only stops buying bonds, but now it's letting bonds on its balance sheet roll off, and that's expected to be $95 billion per month, which is a lot. The Fed's got almost $9 trillion of bonds on its balance sheet between Treasury securities and mortgage securities. So at almost 100 billion a month, it's going to take a year, a little bit more than a year, to go from 9 trillion to 8 trillion, which is still a huge balance sheet. And if inflation keeps going up or doesn't back off, I expect the Fed to actually increase that number. So a lot to say, but the Fed is not going to stop the recession. The Fed is, if anything, is going to cause the recession to tamp down inflation. And based on what Fed governors are saying in terms of how bad the inflation scenario is, they're going all out. They're going to raise interest rates 50 basis points every meeting for the next couple of Fed meetings. The Fed meets every 6 weeks. They would have raised interest rates 0.5% about, I don't know, is it 2 weeks ago instead of 0.25%, had it not been for for Russia invading Ukraine. So the Fed really wants to get going on tamping down inflation, and they want to do it quickly. They want to do it now. And when they come out and say we're getting aggressive, and 3 Fed governors have said that in the last 2 days, and they're using language that's very aggressive, you better believe that the Fed, they're all on the same page. They're, all the governors, they're really going to sink the economy. So when you raise interest rates, you want to slow down the economy, but you don't want to, you don't want to kill the golden goose. But it's when you raise rates, what do you protect? Do you protect the stock market? Do you protect the economy? Do you protect employment? Something has to give. Something has to break. All right. I hope that answers. I feel like I didn't give you the answer you deserve. I'm sorry if I didn't, but we could talk more offline. So that's my story with that. I'm sticking to it. So $95 billion per month is what the Fed's going to reduce its balance sheet by. So roughly $60 billion of treasuries, $35 billion of mortgage-backed securities. So you could see why mortgage rates would be going up. Fed wants to raise rates aggressively, and the Fed is giving up on the soft landing. At least it appears that way. Okay. So, I mean, I think that's just, to me, it's just so significant. And in my career, I've seen aggressive Fed action in the past, in particular around 2000. But I don't ever recall. I've been doing this for 32 years. I don't recall ever seeing the Federal Reserve use such aggressive language, and they're really signaling what they want to do. All right, so won't that hurt wages and Biden's chances of being reelected? Absolutely, Sally. You know, I don't know if you know this. You probably do, but President Biden has, by executive order, decided to pump or let go of a million barrels per day from the United States Strategic Petroleum Reserve, the SPR, in order to get gasoline prices down. Now they're doing that a couple of months before the midterm elections to get inflation down because consumers, we drive by the gas station, we fill up our tanks, it's very expensive. People get upset. So Biden's polling numbers right now are in like the garbage right now. His polling numbers are really, really low. And even though he gets high grades by a lot of people for his handling of the sanctions on Russia and the war there, consumers are suffering. You have shrinkflation. So if you buy a bag of chips like this, for family size, the chips are like, the bag is shrinking, but it's the same size. Consumers are suffering through inflation and they get mad at the incumbent. So this is, I would say Biden's chances of a reelection and the chances of Democrats retaining the House are already so diminished. That's one thing. Another thing is Biden doesn't control, the president, I should say, the president does not control the Federal Reserve. The president can't issue an executive order to lower interest rates or to tell the Fed what to do. The Fed is its own independent branch of government. I mean, you've got Congress, you've got the executive branch, which is the presidency, you've got the judiciary, which is the Supreme Court, and I'd venture to say you've got the Federal Reserve. Okay. So it's not really up to Biden anyway, whatever the Federal Reserve does. It's just, he doesn't have a say in it. Congress has given the Fed its mandate, which is price stability, which is taken as controlling inflation or keeping inflation at bay and maximize employment. And sometimes those two decrees don't go hand in hand. So, yeah, if we shrink the economy or send the economy into a recession, it'll hurt incumbents. It'll hurt the party in power. So, but too bad there's not a whole lot they can do. And since inflation is running so high, I think the party in power is already a loser, no matter how we signal it. Okay, Jesse's out there. Hi, baby. See you later. And that's my daughter, by the way. So those are the big things. Let's take a look at some of the things in the market that we need to be taking a look at. All right, let's just move this over, that over. I'm just getting my screen ready to share it with you. I pop myself up in the corner. So markets mostly recovered. The Dow recovered. It was down over 200, down 144. Not the biggest deal in the world. Let's go down to the S&P, down 1%. Again, it's we've seen much worse days than that. But the Nasdaq down 315. It did bounce a little bit off its low, but basically the Nasdaq got hit really hard. Oil is down. Why is oil down if we have all these sanctions against Russia and people are worried about, oil, global oil supply? Well, if we go into a recession, and that means demand for oil goes down, and China is shutting down Shenzhen. China is just basically shutting down, which reduces its need for oil because it has this incredibly strict COVID, zero COVID policy. All right. The VIX shot up over 20. It was over 20 yesterday. It's up to 22. And the VIX, when the VIX, you see that goes above 20, it's a negative. Below 20, it's a positive for stocks. Okay. And the 10-year treasury backed off a little bit, 2.59, but still it's moved up a lot. But price of oil going down is not because supply has changed. It's because demand is expected to drop off because we could be going into a recession. What I'm trying to say is the stars are aligning for a recession. And typically stocks go down ahead of a recession. Stocks often, by the time we get into a recession, start to recover. But you just have to be comfortable saying, am I, the market's going to go down, I'm invested. Am I going to hold on? I don't think you should sell and try to buy back stocks when they're lower because it doesn't work. All right. I'm not, this is not my thing against timing the market and saying, oh, you can't time the market. You could try. Some people do it. Some people do it well. Some people do it more often than others. But for most of you, if you try to sell and beat the market, because it's going down, so you'll buy back when it's lower, you never do it. It just doesn't work that way because if the market's going down, you got out, you won't buy when the market's going down because you're going to wait for the market to go down even lower. If the market starts to recover, you'll say to yourself, well, I could have bought when things were lower, so we'll wait until they go lower again. And they go lower, and then you think, oh, the stocks are going to even lower again. And you just procrastinate yourself to death and you let too much time go by. Time in the market, okay? Successful investors, and I've met many in my 30 plus years of doing this, they look at their portfolio success. They look at whether or not they're doing well with their investments based on other things that do not include how the stock market is doing. All right. Because if you're basing how you're doing in the stock market based on the ups or downs of the stock market, you're going to spend a lot of time being disappointed. You're not going to be patient. You'll bail out and you'll miss these 15, 20-year runs that you've heard have made so many other people so much money and they could afford to retire comfortably. All right. Don't try to outsmart the economic cycles. People who are successful investors over the long term, they judge how good their investments are doing, how well their investments are doing based on their own actions that they control, like dollar cost averaging in a 401k every month, watching expense ratios, and staying diversified. That's how successful investors judge themselves. They don't judge themselves based on whether or not the stock market or their portfolio is up or down at any given time. They just follow the process and surrender the outcome to later years. Diversification is a strategy that we use to reduce risk, okay, but it doesn't necessarily prevent your portfolio from going down in a generally down market. So I don't want you to think that, oh, I'm diversified, my account should always be up. No, it doesn't work that way, okay? All right, so that is going on, and let's go to another place. Let's look at the bond market today. Bonds. All right, the very short-term 1-month Treasury, the T-bill was up, a drop on the yield. The 10-year 2.59, the 2-year 2.473. By the way, the yield curve, the 2s, 10s year yield curve, is no longer inverted. It was inverted for 2 days. I don't think that's enough to come out and say we are going in a recession in the next 12 to 18 months because you had an inverted yield curve. I don't think 2 days does not make for a enough of an inverted yield curve. It's not long enough. It's got to be for months on end. Okay, let's take a look at crypto. And today we could call crypto crapto. I've never said that before. I just thought of that. When crypto's down, we call it crapto. You get it? Crapto, right? I don't have my iPad set up. I could have done my bum the drum. But Bitcoin down 4.3%. Listen, Bitcoin was recently 38,000, so it went up to about 45, 46,000, and now it's just about 44,000. And as goes Bitcoin is typically how goes the rest of the complex of crypto assets. Okay, so they're all pretty much down. The best performing one is this 3-cent one because it was unchanged on the day. All right. Let's take a look at a couple of stocks that tell us a story, okay? I like stocks that tell us a story. Wabash National, which is a really good company, they make the trailers that go on the back of tractors, so the tractor trailer, for on the back of the 18-wheeler, well, part of the 18-wheeler. They're the trailer, okay? And Wabash makes them, and you've seen their products all over the road. Next time you're driving down the highway and you see an 18-wheeler, you'll see in the back of the tractor on the mud flaps or somewhere it'll say Wabash, and it's like a shape of the United States, and it'll say Wabash. Okay, they are one of the biggest manufacturers of tractor trailers, of the trailers, I should say. Okay, and when there's a recession coming, a stock like this is so incredibly cyclical, meaning economically sensitive, that if you think a recession's coming, a stock like this gets just crushed. And it hit a low today. If you think we're in for a recovery, this is the kind of stock you'd want to jump all over, because this is the kind of stock that could really pop back up. SoFi. SoFi is a consumer finance personal lending company. And I can't believe it, but this stock is down almost its low, down to $8. And that means that either consumers don't have the appetite to borrow or to consolidate their loans, or they can't qualify for the loans, or somebody thinks consumers are going to be defaulting a lot on their loans. Very bad for SoFi, and it's not a good indicator for the economy. But in a 52-week high, the opposite comes from Costco, because Costco had a big update. So it's the highest it's ever been. It's not just a 52-week high, it's an all-time high. Costco is up $9.47 today. All right. So Costco is consumer staples. They sell things you need. I mean, they sell a lot of things that you want, but it's consumer staples. It's where you go to get a good deal. It's where you go to get as much for your money as possible. So the fact that Costco is galloping ahead to new highs while Wabash National is galloping to new lows really shows you the dichotomy of what's working in this market and what's not working in this market. So economically sensitive stocks, the ones that actually do well coming out of a recession, the first ones to start to go up when we're in a recession, like industrials and materials, those are getting clocked. And the late stage ones, the ones that do well at the end of a bull market, the last ones to go up, like consumer staples and healthcare, they're doing very well. But ultimately, I don't think a bear market spares anyone. A bear market is supposed to shake you out, scare you, and get you to start all over again in a year or two or three when things look better. Don't let that happen to you. And this is why I say, what good is an investment strategy, an investment portfolio, if you can't stick with it? So if you don't have the right investment portfolio and your expectations are out of whack with reality, you are welcome to give me a call. We'll talk about it, see if we can get you straightened out and see what you need to do to have a portfolio that you could stick with. There are so many younger new investors. I'm not trying to pick on you, okay? There's so many, if you're a younger investor, there's so many new investors that are just all tech or all crypto or all NFT. And you're the investors who are going through your first substantial correction. If you take a look at, let's say, the ARK fund, ARKK, ARK Innovation, it's not quite at its mid-February, early March low, but it looks like it wants to get there. Remember, the opposite of innovation. So remember, the opposite of innovation is obsolescence. And right now, this is not a market that is favorable to companies with super high PE ratios or are trading on valuation metrics based on, just eyeballs or revenue growth if they don't have the earnings growth. PE ratio means it's the price of a stock divided by its expected earnings. And what's often considered a healthy ratio is a ratio that is either at or below the company's growth rate. But it's not some perfect magical indicator, and it's not something that I even really use when I evaluate a stock. But that's just my opinion. All right, so we've got a lot to talk about. I thank you so much for joining me today. If you have any questions after the live stream, or if you're watching this in the replay and you have a question, definitely hit me up in the comments. I'll see it. I'll get back to you. I love getting back to you. I love hearing from you. And I will see you tomorrow. Thank you very much.